Okay, let's unpack this. When most of us think about where we keep our money, we think about these massive multinational corporations, the big banks.
Right.
They dominate the skyline in the financial news. But there is, well, a kind of parallel universe in finance.
Yeah.
It's an alternative model that is not only vast, but also, as we'll see, demonstrably more stable, more trusted, and structured around an entirely different core purpose. We are diving deep today into the world of credit unions.
That's the perfect setup, really. The documents you've brought to the table, they don't just define what a credit union is. I mean, they fundamentally challenge the assumption that the profit-maximizing, shareholder-driven model is the best or, the only way to run a financial institution.
Exactly.
We're exploring the member-owned nonprofit cooperative, a structure with really deep historical roots and some surprisingly powerful competitive advantages.
Exactly. And for you, the listener, our mission for this deep dive is clear. We're going to give you quick, thorough, expert knowledge on this credit union model. We need to understand its identity, how its unique governance structure creates these real-world differences in stability and trust,
And its history.
its fascinating kind of anti-exploitation history, and its enormous, often underestimated global reach.
And we've analyzed a really comprehensive stack of sources here. It covers everything from the basic structure to global metrics and these complex support mechanisms. And to prove just how compelling this alternative model is, I think we have to start with the most dramatic piece of data in the file.
Oh, I know exactly what data point you mean. It connects the governance model directly to performance. We have to start right there. What is a credit union, and why are small businesses 80% more satisfied with them than with big banks? That is a number that just screams systemic difference.
So the foundational truth of a credit union, the thing you have to get your head around first, is that it's a member-owned, nonprofit cooperative financial institution.
Okay, that's a mouthful. Let's break that down.
Right. So if you want to understand everything else about how they operate, you have to keep those three concepts in mind simultaneously.
Member owned. That means the people who use the services are the owners, right?
Exactly.
And nonprofit means the goal isn't maximizing profit for someone else. Cooperative implies a kind of mutual shared benefit. So when people join, what services are they actually getting? Are we talking about like just a basic savings account or the full suite?
We're talking about a full suite. They provide services that are completely equivalent to any large commercial bank. We're talking about share accounts.
Which are basically savings accounts.
Right, they're savings accounts. Then you have share draft accounts, which function as check or checking accounts. They offer credit cards, various types of loans, mortgages, auto loans, personal loans, and also share term certificates.
Their version of a CD, a certificate of deposit.
Precisely. And of course, they are fully modernized.
Right.
They all participate in online and mobile banking, just like any large institution you can think of.
But the relationship is, it's inherently exclusive, which I guess circles back to that ownership model.
It is. And this is a really crucial difference. Normally, only a member of a credit union may deposit or borrow money. You have to qualify for membership.
How does that work?
Usually it's based on a common bond. It could be geography, like living in a certain county or your employer or maybe an association you belong to. And once you're in, you're not just a customer anymore. You're a part owner. And that creates this self-contained financial ecosystem.
It's interesting. Before we jump into the governance part, I want to briefly acknowledge a crucial geographical nuance from the sources. We use the term credit union, but in places like several African countries, this cooperative model operates under a different name.
Yes, that's key for the global perspective.
Yeah.
They're often called SACCOs.
Exactly.
It stands for Savings and Credit Cooperatives. It's the same cooperative structure, the same member-centric mission, just a different regional term that really emphasizes that dual function of saving and lending within the shared group.
Okay, good to know. Now, let's get to the philosophical heart of the matter, the governance. If a bank is controlled by shareholders proportionate to how much capital they have in, how does the credit union structure truly flip that script?
This is probably the single most important mechanism. In a publicly traded commercial bank, control is directly proportional to capital. It's simple. If you own a huge block of stock, you dictate strategy.
And the CEO's job is pretty clear.
Very clear. Maximize quarterly returns for those shareholders. Period.
But in a credit union,
So in a credit union, the account holders are the members and the owners, and they elect the board of directors using the principle of one person, one vote.
one person, one vote.
It truly democratizes financial control. It doesn't matter whether you have $50 or $5 million in the institution, you cast one vote. This is It's just revolutionary in finance because it completely divorces control from capital.
So if I'm a high net worth individual, I can't just come in, buy up a majority share, and then force the credit union to start making these, high risk, high yield investments to boost my personal returns.
Absolutely not. You have the exact same voice as the person who just opened their first checking account last week. The governance structure ensures that the mission statement, which is community-oriented, aiming to serve people, not profit, remains the top priority.
So success looks different.
The definition of success for the board is long-term member utility, stability, and affordable rates, not short-term share price spikes.
That makes intuitive sense, but
Yeah.
it's still hard to believe that such a simple democratic structure can translate into dramatically different real-world performance metrics.
Oh.
And here's where it gets really interesting, as you said. Let's start with the trust disparity.
The trust data is stunningly clear. In the U.S., public trust in credit unions stands at 60%.
60.
Meanwhile, public trust in big banks, it hovers at around 30%.
Half.
That's a twofold difference. It's massive.
When half the country trusts one type of institution over another, you really have to ask what behavioral or structural differences create that gap. And I'm guessing customer satisfaction mirrors this exact trend.
It does. Completely. Surveys consistently show significantly higher customer satisfaction with the quality of service at credit unions. And that brings us right back to the metric you mentioned at the start.
The small business one.
Small businesses are 80% more likely to be satisfied with a credit union than a big bank.
That 80% figure is it's huge. Why is the small business segment, which is so dependent on efficient, reliable banking, why are they so much happier?
I believe it comes down to relationship banking and the incentive structure. Big banks, they often treat small businesses as just transaction volume.
Another number on a spreadsheet.
Exactly. Credit unions, because of their community focus, are often willing to spend more time understanding a local business's unique needs, especially since that local business owner is also a part owner. The institution is invested in the health of its community, not just the yield of a specific loan portfolio.
That connection between prudence and the member-owner relationship became absolutely critical during the last great financial crisis. Let's analyze that 2006 data on subprime lending because it really illustrates the systemic effect of these different incentive models.
This is, I think, the single most compelling piece of evidence we have regarding stability. Leading up to 2006, commercial banks were under intense pressure to maximize loan volume, and that often resulted in extremely risky behavior.
Right.
Our sources confirm that 23.6% of mortgages originated by commercial banks were categorized as subprime lending.
Nearly a quarter.
A quarter. They were chasing the high-yield, high-risk game.
And the credit unions, governed by their own membership, what was their number?
They exhibited just radical caution. Only 3.6% of mortgages originated by credit unions were subprime.
Wow.
Think about that divergence, a nearly seven-fold difference in risk appetite.
So why? What's the core reason for that caution?
It goes back to ownership. Because if that mortgage fails at a commercial bank, the loss is passed to external shareholders. But if the credit union's mortgage fails, the loss is directly borne by the pooled assets of the members, the people who voted for the board in the first place.
So their prudence is self-imposed.
It is. It's systemically stabilizing.
And that data point alone tells the story of stability. And it had, direct consequences when the crash actually hit.
It did. The documents confirm that commercial banks were 2.5 times more likely to fail during the crisis than credit unions.
2.5 times.
That member-owned structure, focused on asset protection and cautious lending, acted as a fundamental buffer against the systemic collapse we saw elsewhere in the financial sector.
And the story continues past the crisis, especially when it comes to supporting small businesses. The banks, they generally tighten their belts, right? But the credit unions leaned into their community mission.
That's the post-crisis follow-up that truly demonstrates their commitment. The sources track lending activity between 2008 and 2016. During that time, American credit unions actively doubled their small business lending. They went from $30 billion to $60 billion.
Doubled it. And this was happening while the overall financial market was retreating from small business support.
Precisely. During that exact same recovery period, Overall, small business lending in the broader financial sector actually declined by around $100 billion.
So one goes up by 30 billion, the other goes down by 100 billion.
Yeah. So while traditional banks were retrenching and, managing risk from their past mistakes, the credit union movement was stepping into the void. It showed a deep, sustained commitment to local economic growth, and that's a direct consequence of their mandate to serve people, not profit maximization.
The lesson here just seems so clear. That one person, one vote governance system is not some minor footnote in finance. It fundamentally changes the risk-reward calculus, and it leads to institutions that are both more trustworthy and, it seems, more stable in a crisis.
It suggests that when the consumers of a service also control the management, they prioritize long-term utility and safety over speculative returns, creating a more resilient financial ecosystem overall.
Okay, transitioning into our next section, we need to clarify a term that often confuses listeners, not-for-profit. When people hear that, they often think of organizations that run on donations. We need to define the crucial financial reality of being a not-for-profit financial institution.
This is a really vital distinction. Credit unions are absolutely not charities. They are highly capitalized financial entities.
So what does not-for-profit mean then?
The not-for-profit label simply means their surplus funds, the money left over after all the expenses, are not distributed to external shareholders. Instead, those funds are reinvested back into the cooperative itself or returned to the members.
How are they returned?
Through things like better interest rates, lower fees, or maybe enhanced services like a new mobile app.
So they still need to generate money to cover their costs and stay solvent. How is this necessary operating income defined?
They absolutely must generate revenue. The World Council of Credit Unions, WOCCU, clarifies this perfectly. They say they must generate a small profit, or as it's correctly termed in nonprofit accounting, a surplus.
Okay, a surplus.
Right. Their revenues, which come primarily from interest on loans and some prudent investments, have to exceed their operating expenses and the dividends they pay out to members, which is the interest on deposits.
So the surplus isn't about padding a CEO's bonus, it's about maintaining the institution's capital strength.
Correct. That surplus is essential for maintaining capital ratios, for ensuring solvency, for meeting regulatory reserve requirements, and, for funding future growth like new branches or technology upgrades. It's a mechanism for continuous service delivery, not for wealth extraction.
And in the U.S., this status comes with a really significant advantage that allows them to pass greater value back to the members. Tax exemption.
Yes. U.S. credit unions are tax exempt, which is a massive competitive advantage and a direct benefit to the membership. State-chartered institutions usually fall under Section 501c14a of the IRS Code.
And the federal one?
And federally chartered ones are covered by Section 501c1.
Can you just break down what that technical legal phrasing means for you, the listener?
In practical terms, it means they are generally exempt from federal corporate income taxes on their surplus.
Okay. And that matters because
It allows them to operate with a thinner margin, and that immediately translates into tangible benefits for the member. Higher interest paid on your savings and lower interest charged on your loans. They just don't have that large tax liability layer that traditional banks must factor in when they're setting their rates.
that makes the not-for-profit status a powerful economic tool for the community. Now, before we look globally, let's quickly define the two structural types of credit unions that exist in the marketplace beyond just the retail consumer focus.
Right. So we have the familiar ones, the natural person retail consumer CUs. These are the frontline institutions serving individuals like you and me. But then you have this crucial, less visible layer, corporate credit unions.
And those corporate CUs are kind of the internal backbone of the system.
Exactly. Corporate credit unions do not serve individuals. They serve other credit unions. Think of them as the cooperative's cooperative. They provide these essential services that small local credit unions just couldn't afford on their own.
Like what kind of services?
Things like operational support, funds clearing, and most importantly, liquidity management.
So if a small credit union in, say, rural Idaho suddenly faces high seasonal demand for farm loans and needs short-term cash, they turn to their corporate credit union, which acts essentially as the movement's central bank access point.
That's the perfect analogy. They pool resources and act as a crucial operational and financial intermediary. It allows thousands of small, independent credit unions to compete effectively with the scale and infrastructure of a national megabank. It's cooperation at the institutional level.
Okay, now let's zoom out, because the scale of this cooperative financial structure globally is massive, and I think it surprises most people who only focus on, Wall Street or the city in London.
The footprint is enormous. According to WOCCU data from 2018, there were 85,400 credit unions operating in 118 countries.
Wow.
And they collectively serve 274.2 million members, managing assets totaling $2.19 trillion.
$2.19 trillion managed under a democratic one-person, one-vote system. That's a powerful statistic, and the growth is accelerating.
Incredibly fast. Just between 2016 and 2018, over 100 million new members were added worldwide. That just speaks to the ongoing urgent need for this model, especially in developing economies where financial inclusion is so critical.
And we should quickly mention that this WOCCU data, it actually excludes the massive cooperative banks in Europe, like those in Germany or France, which grew out of the same movement but are structurally defined a bit differently today.
Right.
If we counted those, the global cooperative financial footprint would be vastly larger.
It would be. I mean, the model pioneered by the Germans is a cornerstone of European finance, and their exclusion from this specific metric just emphasizes the scale of the credit union model itself.
Looking at membership volume, which countries dominate the credit union movement?
The U.S. leads with about 101 million members, which reflects its large economy. But the international spread is significant. India follows with 20 million and Canada with 10 million.
And beyond that?
You also see massive representation in places like Brazil, South Korea, the Philippines, Kenya, Mexico, and Ireland. It is truly a globally adopted response to local financial needs.
Now, volume is one thing, but the saturation rate, the percentage of the economically active population that chooses the credit union model, that reveals the depth of reliance in certain nations. And these numbers are staggering.
They absolutely reframe who is defining the financial system in certain parts of the world. So the global average is around 8.2% saturation. But look at Barbados.
Okay.
82% of its economically active population are credit union members.
82%.
Ireland follows at 75% and Grenada at 72%. You got Trinidad and Tobago, Belize, St. Lucia, all are over two-thirds saturation.
So in Barbados, for every 10 working adults, 8 of them choose the cooperative structure as their primary financial relationship. That's not an alternative. That is the mainstream financial institution.
It demonstrates that when financial institutions are highly localized, reliable, and governed by the community, they can not only compete with, but entirely overshadow large commercial banking entities. And even in North America, the rates are high. The U.S. sits at 48% saturation and Canada at 43%.
That suggests a very healthy level of competitive appeal. And we have a specific example of this competitive edge in Latin America from the sources.
Yes, Costa Rica. Following some financial reforms that were designed to level the playing field, Costa Rican credit unions grew faster than both state-owned and private sector banks.
How significant was that growth curve?
Over 2 decades, from 1996 to 2016, they almost tripled their share of the financial market. They grew from 3.7% to 9.9%.
That's pretty amazing.
It indicates that when market conditions are fair, the credit union's inherent stability and mission-driven approach are powerful attractors for consumers and businesses alike.
It's clear that this is a systemically important, globally scaled model. To understand its resilience and its mission, I think we need to trace those values back to their origins, which takes us to the deep roots of the cooperative movement in the 19th century.
It's a history defined by social necessity, not commercial ambition.
Our sources take us back further than most history books on banking. While the modern structure is often credited to German pioneers, the first documented cooperative financial institution actually emerged in Slovakia.
That would be Spolek Gazdowski. It was founded in 1845 by a man named Samuel Jerkovich. This was Central Europe's first cooperative financial body, and its mandate was simple yet radical for the time.
Which was?
To provide cheap loans using funds pooled from the regular savings of its members. It was pure community self-help.
And the requirements for membership here are what truly illuminate the foundational philosophy of the entire credit union movement. It wasn't just about financial solvency, was it?
No, not at all. It was a holistic view of community health. Members were required to commit to a moral life which emphasized sobriety and good character, and crucially, they had to plant 2 trees in a public place every year.
Wait, plant 2 trees annually. What does that requirement tell us about the original DNA of the cooperative?
It tells us that Jerkovich viewed financial stability as being inseparable from civic duty, moral responsibility, and even environmental stewardship. It wasn't just a ledger. It was a societal improvement mechanism. You didn't just borrow money, you became a better citizen, and you physically contributed to the long-term health and beauty of the shared community space.
That is fascinating.
This idea that financial access comes with a responsibility to the commons is just baked into the foundation.
Although that specific cooperative only lasted until 1851, its philosophical impact was immense.
It was the template for the whole cooperative movement in Slovakia. National leaders immediately saw its potential as a tool for social uplift. Ugave Tutur, a critical figure in Slovak nationalism, praised it highly, saying such constitutions would help to rescue people from evil and misery.
Wow.
They saw it not as a bank, but as a mechanism to rescue the poor from indebtedness and exploitation.
That philosophical precedent then gained its permanent, globally scalable structure thanks to the German pioneers in the mid-19th century.
Precisely. We see the emergence of two parallel modern tracks. First, there was Franz Hermann Schulz-Delitzsch, starting around 1852. He consolidated some early pilot projects into the first recognized urban credit union system.
Urban, so for city dwellers?
Yes, designed primarily for the small shopkeepers, artisans, and tradespeople in towns and cities. They needed short-term capital for their businesses.
And the second track addressed the massive rural population.
Yes. Friedrich Wilhelm Raiffeisen, who founded the first rural credit union in Hedsdorf, Germany in 1864. Rural communities had different needs: seasonal borrowing, long-term stability, and Raifesen's model, which was based on unlimited liability among members, ensured deep commitment and local oversight.
By the late 1880s, these models had proven successful enough to begin their rapid spread across Europe.
By the time of Raifesen's death in 1888, the model had traveled to Italy, France, Austria, and England. The need for affordable, accessible credit was universal, and the structure proved easily adaptable to different national legal systems.
And that sets the stage for North America, where the movement took root specifically as a reaction against exploitation and systemic exclusion.
The North American origin is driven by a very specific moral outrage. The story starts in Quebec, Canada, with a man named Alphonse Desjardins. He was a legislative reporter. In 1901, he founded the Caisse Populaire de Lévis, which we consider the first in North America.
And his motivation, it was deeply personal and dramatic, wasn't it?
It was. The sources highlight that in 1897, Desjardins was galvanized when he learned that a court had ordered a Montreal resident to pay nearly 5,000 Canadian dollars in interest on a loan of only $150 from a moneylender.
$5,000 on a $150 loan.
Yeah. That level of usury, of predatory lending, it just shocked him. He realized that the law offered no protection against financial exploitation and that only collective action could protect the working poor.
So he didn't start a bank, he started an anti-exploitation movement.
Exactly. He adapted the European models to create a uniquely Canadian, parish-based cooperative structure. The Caisse famously began with a minuscule 10-cent deposit. It was a symbolic start, demonstrating that access to finance shouldn't be reserved for the wealthy.
And Desjardins' influence then quickly crossed the border, founding the first U.S. credit union.
The first U.S. credit union, St. Mary's Bank Credit Union, opened in Manchester, New Hampshire in 1908. And Desjardins personally advised the founders, who were French-speaking immigrants from Quebec.
And what was the necessity driving that specific group?
It was twofold. There was the need to escape high-interest loans and, critically, the reality of systemic exclusion. Anglo-American banks at the time often rejected loan applications from these French-speaking Catholic immigrants.
So they had no choice.
The credit union was a necessary vehicle for economic survival and integration into the U.S. economy when the mainstream system either failed or just refused to serve them. America's Credit Union Museum now preserves that original location, emphasizing its importance as a landmark of financial inclusion.
And the movement proved that the common bond principle could extend beyond just ethnicity or faith.
Absolutely. The need for community finance was recognized very quickly. By November 1910, the Industrial Credit Union was established in Boston. This was significant because it was the first non-faith-based community credit union, explicitly designed to serve all people in the greater Boston area, which really broadened the demographic reach of the cooperative structure.
So the history shows this recurring theme. Whether it's 1845 Slovakia, 1864 Germany, or 1901 Quebec, the cooperative movement is born as a stable, ethical alternative when traditional finance proves to be exploitative or exclusionary.
And that thread continued as the movement expanded globally, notably throughout Latin America in the mid-20th century. Following World War II, the Catholic Church championed credit unions as a means to empower the poor.
And that led to huge growth.
Huge growth in the 1950s and 60s in countries like Peru, Bolivia, and Costa Rica.
This rapid expansion, I assume, necessitated a more structured regional body.
It did. The Regional Confederation of Latin American Credit Unions, COLAC, was formed, consolidating efforts and receiving international backing, including funding from the Inter-American Development Bank. By the late 80s, this confederation represented millions of members across 17 countries.
But this growth hit a significant wall with the economic instability of the 1980s. Even the cooperative model wasn't immune to these macro forces.
The late 1970s and 1980s were incredibly challenging. High inflation devastated the value of savings, it stagnated membership growth, and it led to severe loan recovery problems. When the Latin American debt crisis hit in 1987, the region saw bank runs, massive withdrawals, and very high default rates.
How did high inflation specifically damage the cooperative structure?
Well, inflation erodes capital reserves extremely quickly. So if a credit union lent money at a 10% rate and inflation was 50%, they were essentially losing value on every single loan they made. This, combined with systemic default, caused critical liquidity problems across the region, demonstrating that even with the best intentions, adequate regulation and macroeconomic stability are essential for any financial institution to survive.
That difficult history leads us directly into our final section, which is critical for reassurance. How the modern credit union system ensures its stability and safety through insurance and these cooperative networks.
The global movement learned from those crises, recognizing that a good mission must be backed by ironclad financial stability mechanisms.
Okay, so given the historical vulnerability we just discussed, you, the listener, need to understand the modern safeguards. How do credit unions legally and financially manage risk and ensure the safety of deposits today, in a way that's analogous to how commercial banks do it?
In terms of stability management, they are regulated much like banks. In nearly all jurisdictions, credit unions are legally required to maintain a reserve requirement.
Which is what exactly?
It's a specific ratio of assets held versus liabilities, which are the deposits. This mandatory cash buffer ensures they can handle day-to-day withdrawals and minor shocks without immediate insolvency.
And if, despite these reserves, a credit union does become insolvent, what's the legal process for protecting depositors?
The process is determined by bankruptcy law. If insolvency occurs, the remaining assets are distributed in a specific order of seniority to creditors, and that includes depositors. If the institution's assets are insufficient to cover all the deposits, that's where deposit insurance becomes the vital layer of protection.
Okay, let's break down that deposit insurance structure, starting with the largest market, the United States.
In the U.S., the protection is robust and highly standardized. Federal credit unions are chartered and overseen by the National Credit Union Administration, or NCUA. The NCUA provides deposit insurance through the Share Insurance Fund.
And that's a federal guarantee.
Yes, it's a federal guarantee, very similar to FDIC coverage for banks. It currently insures accounts up to $250,000 per member per insured institution.
But the U.S. structure is slightly more complex because of the state-chartered CUs.
That's right. State-chartered credit unions have the option of using the NCUA, or they can utilize a private insurer. The sources highlight American Share Insurance, or ASI, based in Ohio, as the largest private deposit insurance fund for credit unions.
So there's an alternative.
There is. But it's important to note that state governments themselves do not provide the insurance. It's either federal or a private industry fund. But the coverage levels are generally designed to be equivalent to the federal standard.
That nuance is important, that competition in the insurance market exists, but the outcome for the member, the coverage, remains robust. How does this compare to the model in Canada?
Canada's system is primarily provincial. The majority of credit unions are incorporated at the provincial level. Therefore, their deposit insurance is provided by a provincial crown corporation. For example, in Ontario, the Financial Services Regulatory Authority, or FSRA, insures deposits up to a high limit, currently $250,000 Canadian dollars.
And if they have a federal charter in Canada?
Then they fall under the Canada Deposit Insurance Corporation, the CDIC, the federal insurer, much like commercial banks. It's a decentralized system that maintains equivalent high levels of protection across the board.
Okay, and moving to the UK, how are credit unions treated under the consumer protection schemes there?
The UK system integrates them seamlessly. Credit unions are covered by the Financial Services Compensation Scheme, the FSCS. This scheme protects deposits up to £85,000 per consumer per institution.
So it's the same level of protection.
It ensures that a UK credit union member receives the exact same level of government-backed protection as a customer of a major UK bank. The key takeaway for our listener is that membership in a credit union does not mean sacrificing safety.
That provides critical financial reassurance. Now let's explore the unique advantage the cooperative model has, which is its ability to cooperate amongst itself to enhance efficiency. What's fascinating here is the network effect created by these specialized support entities.
This is where the cooperative structure truly shines in competing with the scale of megabanks. These institutions often form what are called credit union service organizations, or CUSOs.
And CUSOs are distinct in that they are typically set up as for-profit subsidiaries. That seems a little counterintuitive to the not-for-profit mission.
It's an essential nuance. CUSOs are for-profit entities, but they are owned by one or more credit unions. Their purpose is explicitly mutual support. By setting them up for profit, they can operate efficiently, attract talent, and deliver sophisticated competitive services.
What kind of services?
Things like shared IT, credit counseling, or insurance back to the parent credit unions at cost, or with minimal overhead. The profit generated remains within the cooperative family.
Can you give us the most powerful example of how this pooling of resources allows small, local CUs to compete nationally?
The clearest example is KOP Financial Services. This is the largest credit union-owned interbank network in the United States. Through KOP, thousands of small independent credit unions collectively own and operate massive networks of ATMs and shared branching services.
So a member of a tiny credit union in, say, rural Oregon can walk into a shared branch in Florida or use an ATM across the country fee-free because their small local institution is part of a national cooperatively owned network.
Exactly. Without this CUSO structure, that small credit union could never afford to build its own national infrastructure. By pooling resources, they achieve economies of scale and offer the nationwide convenience and accessibility that was once the exclusive domain of only the biggest, wealthiest banks. It's cooperative resilience in action.
This internal cooperation is then complemented by external advocacy and development through powerful trade associations. Let's quickly highlight the key players that manage compliance and global growth.
In the U.S., the major player is CUNA, the Credit Union National Association. They are the national trade association for both state and federally chartered CUs, providing advocacy in Congress and regulatory guidance. They also oversee the National Credit Union Foundation, which is their charitable arm focused on financial education.
And for those institutions focused specifically on the federal regulatory environment in D.C.,
That would be the National Association of Federally Insured Credit Unions, or NAFCU. They specialize in federal advocacy, compliance assistance, and education, making sure that the voice of the credit union movement is heard clearly in Washington on matters relating to federal regulation and oversight.
and finally, the global organization whose data proved so critical to our understanding of the worldwide footprint.
The World Council of Credit Unions, or WOCCU. This is the global trade body and a major international development agency. WOCCU's mission is expansive. They aim to organize, expand, improve, and integrate credit unions worldwide. They are the strategic, the ideological, and the operational backbone, working actively to establish and strengthen cooperative financial services in developing nations where financial access is often difficult.
So the overall picture is clear. Credit unions are not just benign local players. They are highly structured, mutually supportive, globally integrated institutions protected by robust insurance and supported by sophisticated internal networks designed explicitly to overcome the scale disadvantage of competing against traditional profit-driven banks.
Yes.
Hashtag outro. So this deep dive has, I think, fundamentally redefined what a credit union is for many of us. We started by challenging the idea that the profit-maximizing model is the only successful path in finance, and the data overwhelmingly supports the cooperative alternative.
We established that credit unions are member-owned, and that defines their success by community utility, not by shareholder returns. And this leads directly to measurable benefits. Double the public trust, 60% versus 30%.
Right.
Vastly higher customer satisfaction, especially for small businesses. And critically, a proven record of systemic stability, illustrated by their minimal involvement in risky subprime lending during the 2006 crisis.
And this resilient model is rooted in a history of anti-exploitation. From Samuel Jerkovic's Moral Cooperatives in 1845, which required members to plant trees,
Amazing detail.
to Alphonse Desjardins' creation of the North American movement as a direct counter to usury. And today, the structure is a globally adopted financial mainstream, serving 274 million members and dominating financial activity in high-saturation countries like Barbados and Ireland.
And if we connect this to the bigger picture, the endurance and phenomenal success of the credit union model across 118 countries suggests a persistent, global, and I think fundamental need for financial institutions whose governance structure, that one person, one vote system, prioritizes community stability and membership benefits over external shareholder demands.
It's a different incentive system.
This system insulates them from the short-term risky pressures that so often destabilize publicly traded banks.
It provides a powerful, proven blueprint for sustainable, ethical, and localized finance that works at a trillion-dollar scale.
Indeed.
So that brings us to our final provocative thought for you, the listener, something to mull on long after this deep dive ends. Given the overwhelming data we've reviewed, showing credit unions are less prone to risky lending and enjoy consistently higher public trust, what specific role should their unique cooperative governance model play in the wider discussion of global financial regulation and consumer protection? If the goal of regulation is systemic stability, should the member-owned nonprofit structure be actively incentivized or perhaps even mandated for institutions that provide essential community-focused financial services? Should we be asking why this model remains the alternative instead of the standard?